India enters 2026 near all-time highs, but the tape isn't behaving like a clean bull run. Tight ranges, cautious risk-taking, and pressure building under the surface. Our thesis is simple. The index is likely capped, but dispersion will be extreme. And that's where the opportunity is. The post pandemic rally was powered by earnings compounding and valuation re rating. In 2026, we move into a macro dominated regime where currency, flows, and the cost of capital start driving outcomes. If you want the full framework, scenarios, triggers, and charts, refer to our slide deck linked in the description. For 2026, we treat two variables like main characters: USD INR because it governs foreign risk budgets and flows, and India's 10-year yield because it sets the discount rate and valuation ceiling. The rupee is hovering around 89.97, and 90 is the psychological line. The key is not only the level, but the speed. A slow grind is manageable. A fast break can trigger a feedback loop, risk budgets tighten, flows turn defensive, and equities derate. The second variable is the 10-year yield, around 6.57%. When yields are sticky or rising, the market's willingness to pay high multiples reduces. Higher discount rates compress justifiable PEs, creating a ceiling for index returns. That's why we call this a capped index setup. At these levels, Nifty is trading around 23x trailing earnings. To break higher sustainably, you need a clear liquidity impulse or accelerating earnings upgrades. In the base case, the setup is more balanced, modest upside, real downside. But the market doesn't stop moving. When the index is capped, it separates. Dispersion stays high. Returns are driven by execution, order books, niche dominance, and policy tailwinds, not by index beta. So our 2026 playbook is a barbell. On one end, aggressive down cap exposure, select microcaps and small caps with idiosyncratic growth. On the other end, a hard asset hedge, primarily gold and selectively silver, to protect against correlation spikes and FX volatility. Down cap isn't a blanket small cap call, it's a selection framework. We want businesses where outcomes can decouple from the macro tape because the driver is execution, capacity, market share, order book conversion, operating leverage. Our preferred buckets map cleanly to this regime. Defense, a multi-year execution theme. Manufacturing and specialized engineering microcaps, niche leaders with room to surprise. Metals, a tactical reflation trade. And financials, because they offer a valuation cushion versus expensive high duration pockets. Macro led years can create correlation shocks. Equities and bonds selling off together. Hard assets earn their place here. Gold is the cleaner INR hedge. Silver is higher beta, supported by industrial demand dynamics, more volatile but powerful when trends run. We avoid point forecasts. We anchor outcomes mechanically. EPS growth versus terminal PE. In the base case, index upside is limited, while downside scenarios become real if INR weakens sharply or yields rise. That's why we prioritize alpha over passive index exposure in 2026. Ignore noise. Watch four signals. 1. USD INR velocity. 2. Double outflows. Equity and debt both negative is high signal. 3. System liquidity. Tightening to defend FX raises discount rates. 4. India-US trade progress. The positive optionality lever that can change foreign risk appetite. Our bottom line is simple. 2026 is unlikely to reward passive beta the way the post-COVID cycle did. It's a year to stay selective, lean into idiosyncratic down cap opportunities, and pair that with hard assets for macro shocks. And if you want our detailed take, charts, scenarios, and trigger levels, refer to our slide deck in the description. Capped index, high dispersion, active wins when it's hedged. This material is for information and education only and should not be construed as investment advice. Markets involve risk. For disclosures, refer to quantace.in/disclosures. Goodbye and see you soon.